So the Federal Reserve have completely messed up and they are very close to causing a recession in the US economy. And today we're going to look at how badly they have messed up, how inadequate they are at their job, and also the fact that they have not called an emergency meeting to rectify the problems that they have caused now because of how poor they have been with their decision making with their current interest rates. They've made very big errors on the inflation when it's gone up and how slow they have been to put interest rates on the way up. And now they've done exactly the same on the way down. They've been very slow to start cutting their interest rates when the economy is slowing and inflation has been beaten. So let's look at how bad the Federal Reserve have got this decision in the last few days, and also the mistake they've also left themselves in the next coming few months. Hope you enjoyed the video. Let's get started. So I did briefly cover this in yesterday's video, but I wanted to give you a little bit more information about how bad the Federal Reserve have got this, how inadequate they are at their job, and also the knock-on effects, the consequences of their decision not to start cutting interest rates. So Jerome Powell, this man is the reason why we are potentially going to see a recession in the US economy. He's the reason why currently the Nasdaq is having an official correction and the S&P is well on the way to having an official correction. So the Fed, I don't know what happened to them. They've been asleep at the wheel. They were asleep at the wheel 2 years ago when inflation started creeping up, but they've been asleep in the last few months. I am shocked to see how slow they have been to seeing all the negative data that's been coming out. Before the meeting, we saw that US manufacturing dropped to an 8-month low. One of the key signs that the economy was starting to slow out there. The next thing is earnings. I have no idea what they have been doing through Q1 earnings season, as there was clear cracks in Q1 earnings season that the consumer was getting weak. When we got into Q2 so far, the last 2 weeks, the earnings have been very poor. Wells Fargo put a report out saying only 40% of companies are beating earnings. This is normally 60%. And if you go listen to any consumer stock, I would say up to 80% of the consumer stocks, they are all saying how weak it is out there. So even if you think one of these stocks is maybe a bad company, the time is done, it's just that they're having a bad time because they're a bad business. When you start seeing multiple companies saying the same thing, you start noticing that maybe this isn't just one company being terribly managed. This is maybe a trend with the consumer. The consumer is not going out there and spending money. You go look at Nike. One of the premium brands out there, they're saying they're seeing a gloomy economy. You look at Tesla, they're seeing sales slow down. You look at McDonald's, you look at Starbucks, Target. You even had the Wayfair CEO coming out the other day, and he said that he is seeing similarities to 2008 recession. When you have all these companies coming out and saying the same thing, how have you not seen the weakening economy? Listen to the companies and let them tell you how weak that economy is going out there. And I've only selected a few here, guys. I've selected, 4 or 5 companies here. I could probably say at least 15 different companies off the top of my head that have said exactly the same thing. And yet the Fed somehow has not seen this and thought, you know what, the economy's still in a strong place. Let's keep these interest rates at the levels that they are at. They've not seen the consumer weakening. And there's even past the company's earnings, there's so much more data showing how weak the economy is out there. Now, obviously, the big thing is that it's come even more clear that the economy is getting very weak out there because US employment that was supposed to come in at 4.1 came in at 4.3%. That is a big drop. And also job additions as well were very weak as well. I think the miss was around about 70,000 jobs, which is not good. But this is, like I said, this isn't something new. We've seen the U-shape in the unemployment data the last couple of months. It's been ticking up, and there's clearly a U-shape that's been created in the US unemployment data, and it's starting to rise up very quickly. This isn't something that's just happened out of nowhere. This is something that I've been calling out on the YouTube channel for the last few months, and I don't know how I am noticing this before the Fed that are paid to notice all of this. Me in this office, I don't know how I am noticing this before the Fed. And it shouldn't be a surprise really though, because we know how inadequate they are at the job. Half the reason why we're in this mess is because of the Fed in the first place. They were very slow to react to inflation going up. The first time we had an interest rate hike to combat inflation was March 17th, 2022, with a 25 basis points. It wasn't even a big hike. Like, it was eventually 2 months later when they realised, actually, we probably need to start hiking up really fast. It wasn't even until June they actually realised how bad the inflation data was. To put it into context on what inflation was at that time, in March 2022, we were seeing 8.5%, 4 times the Federal Reserve's target. Now we're currently sitting at slightly above the Federal Reserve target. But if you look at what the current interest rates are, the interest rates are massively above what currently inflation is, and they're not moving down at all. So how they got to March time last year and then all of a sudden thought, actually, we'd probably start putting the interest rates up here to combat inflation is unbelievable. This is something that if you look at the data, as soon as we ended up getting towards consistent months of double the inflation target, we should have been putting interest rates up back in 2021. And because of the slow reaction to the Fed, we had inflation starting going out of really big control. And now on the other way down, as the Fed historically does, it's slow to react to inflation coming down. You don't get to 2% and then start cutting interest rates, because it takes a while for these interest rates to come into affect the inflation or start affecting the economy. For example, when these interest rates came in 2022, it took them really until 2023 to start taking effect. So these higher interest rates at the moment, even if you start cutting at the moment, you're not going to start seeing the effect of these interest rates until 3, 4, 5 a year down the line. When people, as soon as these interest, people are saying to me in the comment section of yesterday's video, it's good that the economy is getting weak because they're going to cut. Which is kind of true, but the problem is you don't want to get the economy weak and then start cutting, because the next day, if you start cutting these interest rates, it's not going to start showing through into the economy straight away. You're going to have to go through 3 months, 4 months pain to get the results. All these people that will take advantage of the lower interest rates are not going to start taking advantage of it the next day. It's going to take a couple of months before people start taking advantage of the lower interest rates. So you don't get to a recession or a slowing economy and then start cutting. You do it before you get there to avoid the pain. And what has happened in the last few days is clear that we have not cut early enough, and we are going to start having the pain. So even if the Fed start cutting now, which they're not doing, because like we said, they only met a couple of days ago and they decided we are not going to cut interest rates, then we are not going to see now potentially a cut until September, mid-September. Now the problem with them meeting in mid-September now is that the problem is that we're going to get 2 more inflation readings by then. We're going to end up getting the one from July in August. We're then going to get August reading in September. We're going to get 2 batches of inflation data. Now in 2 more months, what's going to happen is we've got 2 high readings that are going to come out of the inflation data. We're going to have the August inflation data coming out and the September one. When these 2 readings come out, inflation is already at 3%. If you actually look at some more up-to-date information, not the data that the Fed use, because the data the Fed uses is heavily weighted into lagging sectors like housing. If you actually look at some more relative inflation data, like true inflation, we're actually down at 1.5% now. And by the way, true inflation data picked up that inflation was getting very high before the Fed's data as well. So it shows you that it works both ways. And when we have these next batches of data come out, we are going to be in the 2% range. And also the fact is that if we are heading towards a slower economy, that's going to help bring inflation down, because oil prices will go lower. All these companies' earnings, because they're so weak, they're going to have to be more price competitive. So they're going to have to bring their prices down. And we're going to be pretty much in that 2% range. But the problem is now that we've got this slowing economy, and what we're going to do to deal with it? Well, the problem is that the Fed, that should have cut 3 or 4 months ago when the data actually started getting weak, should have even done it this week on the 31st of July. They should have cut it this time. And even then, when they saw all this weak data, they kind of went, no, we're going to leave it for now. And the problem is now, because the Fed have left it so long, we're actually not going to get a cut at least. I think they've got a cut in September. We're not going to have at least a cut now until 2 months' time. So if anything, the economy is only going to get worse in 2 months. And then when we do finally get the cut in September, the problem is that this isn't going to start kicking in until probably at least November, December time. The first signs of it kicking in won't be until 2 months' time. And this is the problem. This is why the Fed should have cut 3 months ago. Because if they cut 3 months ago, now we would have at least started seeing the effects of the interest rates cut coming in. And we wouldn't probably have had this weak job data. And the other benefit is that at least if they cut, we would have known, okay, it would have given people a little bit more optimism. Okay, the Fed is now starting to move into the right direction. They're giving us confidence that they're going in the right way. But because they did not do that, everyone spooked about, well, 2 months' time it's going to be a lot worse. And then we'll get to September. Are they definitely 100% going to start cutting in September? And this is why the Fed at the moment, they have gone on the summer break. I have no idea how they have made this decision and then go, actually, yeah, we made the right decision. In my opinion, now they should be calling an emergency meeting, because the data that's come out is terrible, and yet we're not going to have any sort of solution to it in the next 2 months. It's absolutely shocking decisions from the Fed, and I still can't believe this week that they thought, you know what, we're going to keep interest rates the same. It was a terrible decision. And what this shows once again is the Fed are doing the same mistakes as they always do. Just as we saw 2 years ago, they made the mistake of not putting interest rates up quick enough and we had sky high inflation. We're seeing the exact same as they always do. They're too slow to bring the interest rates down. They only end up doing it when the cracks appear in the economy, and then by then it's too late. And in my opinion, we're getting the same again. The cracks have been appearing in the economy for the last 3-4 months, and now they've only just decided to start, well, they're not even cut interest rates. They're thinking about cutting interest rates. So we'll see where we are in another 2 months' time when we do get the meeting in September, and if they finally make the right decision. But by then, we're another 2 months into this weak batch of data. And what will that happen? What will that cause to the economy? What will that do to the next 2 months of job data? What will that do to Q3 earnings from businesses? Yeah, it's going to be a volatile couple of months, guys, in my opinion, and we'll see where we end up in September. Hope you enjoyed the video. If you could, hit the like button. If you do want to join the Patreon and see what advantages I will take in the stock market if we do have a recession, I've already started making a few moves. Send me an email, jkinvesting@gmail.com. You can get on the Patreon for £45 and you get to know my live buy and sell alerts and get access to over 100 videos on there. Hope you enjoyed it, guys. See you in a bit.